Revenues are up at Cisco Systems. Sales at the computer networking equipment maker jumped 10% to almost $10 billion. The outlook from Cisco Chairman John Chambers coming up.
Fannie Mae's chief executive says when it comes to the mortgage mess, we're still in the thick of it. While the mortgage giant sees further home price declines, it's working on new initiatives to keep more borrowers in their homes.
Downturn? What downturn? Disney says its theme park and resort business is going strong despite the nation's economic woes. The Magic Kingdom's better-than-expected results top tonight's stocks in the news.
Then we continue our look at the state of the real estate market with a very unique market, New York City. Home prices in Manhattan have held up while prices around the nation have slumped dramatically.
I'm Paul Kangas.
And I'm Susie Garup. This is Nightly Business Report for Tuesday, May 6th.
Nightly Business Report is made possible by
Franklin Templeton Investments, providing a unique perspective through the specialized investment expertise of Franklin Templeton Mutual Series and Fiduciary Trust. Franklin Templeton Investments, gain from our perspective.
This program is made possible by contributions to your PBS station from viewers like you. Thank you.
Good evening, everyone. Cisco Systems posted better than expected quarterly earnings and revenues late today, and shares of the computer networking giant rose 2% in after-hours trading. Excluding special items, Cisco earned 38 cents in its fiscal third quarter, 2 cents more than estimates. Revenues jumped more than 10% to $9.8 billion. Looking ahead, Cisco expects revenues to grow 9 to 10% in its fiscal fourth quarter and 12 to 17% long term. Cisco Chairman and CEO John Chambers will join us a little later in the program to discuss those results. Also reporting earnings today, Fannie Mae, the nation's largest buyer of home loans. Fannie lost $2.2 billion in the first quarter, or $2.57 a share. The government-backed firm blames the losses on widening credit spreads, larger than expected home price declines, and severe loan losses. And as Stephanie Dew reports, Fannie sees home prices heading even lower.
Fannie Mae's losses come as the company is under pressure to do more to help stabilize home prices. CEO Daniel Mudd says despite its current losses, Fannie's future is bright.
As the initial shock of home price declines dissipates and markets settle down from the enormous volatility of the past 9 months, we are seeing terrific opportunities.
Today, the company announced a series of initiatives to help housing recover, including the option to refinance up to 120% of a property's current value for borrowers who owe more than their home is worth, a rent-to-own initiative for communities hard hit by foreclosures, and Fannie will buy jumbo loans, those more than $417,000, for the same terms as smaller loans. The mortgage giant is also getting a break from regulators. Today, the Office of Federal Housing Enterprise Oversight lifted the restrictions imposed in 2006 to address Fannie's accounting problems, and the regulator lowered the amount of capital the company must hold. In response, Fannie Mae will raise $6 billion in new capital and cut its dividend. But finance expert Tom Stanton says the government-sponsored firm will need more capital than that.
Capital is the deductible on the federal insurance policy. Once they burn through their capital, if they're taking serious losses, as they have been, then we taxpayers are on the hook. Also, there's tremendous potential for systemic risk since so many other institutions hold their paper.
Fannie Mae's market share has increased to almost 50%. While some see that as a concentration of risk, mortgage industry consultant Howard Glazier says the current risk in Fannie Mae's portfolio is from past loans.
Whatever risks there are from the loan portfolios that have been in place for a while. The new loans that are being made now are as safe and sound as any loans that have been made in decades. And that's a good sign for both Fannie and for the mortgage market.
Still, Fannie Mae expects the next couple of years to be rough for housing. Today, the company says it sees even more declines, with home prices falling up to 9% this year. Stephanie Dew, Nightly Business Report, Washington.
Wall Street opened in a broad sell-off on big losses from Fannie Mae and homebuilder D.R. Horton. 30 minutes into trading, the Dow was down 105 points, NASDAQ off 15 points. A further spike in oil prices added to the early selling as crude topped $122 per barrel, with oil traders reacting to Goldman Sachs' prediction of $200 a barrel oil within 2 years. That, however, rallied the oil stocks and the buying spread into the depressed financial sector this afternoon. So by the final bell, the market in general was nicely higher. The Dow Industrial Average closed up 51.29 at 13,020.83. The Nasdaq Composite rose 19.19, ending at 2483.31, while the Standard & Poor's 500 Index was up 10.77 at 1418.26. In the bond market, the 10-year note fell 12/30 seconds to 96 20/30 seconds, putting the yield at 3.92%.
In recent weeks, stocks have been on the upswing on the growing belief that the worst of the credit crisis could be over. But as Erica Miller explains, most Wall Street pros don't see a strong recovery for stocks anytime soon.
After a long wait, hope appears to be creeping back into the stock market. The S&P 500 has risen 11% from a 19-month low hit March 16th. S&P market strategist Alec Young credits optimism about earnings and the economy.
So there's a sense that while things are still kind of murky in terms of the housing market and high gas prices, that overall, the worst of the economic news is over in terms of its impact on earnings, and that pressure will be less as we move forward than it's been over the last few months.
In addition, he says investors believe credit conditions are improving, thanks to the Fed's massive injection of liquidity into the banking system. But some analysts are more bearish about the near-term outlook for stocks, warning this could be a sucker's rally. Citigroup's Tobias Levkovich worries corporate earnings will disappoint in coming quarters due to a lagging impact of tight credit conditions.
I would expect that it's going to take a few months for companies to come out and tell investors that the business conditions aren't quite as good as they thought, going back a month or two even. And that tends to take a little bit more time than we'd like. Usually summer is a tough time in stocks.
Historically, May has been the start of the weakest 6-month period for stock prices. That is reflected in the well-known Wall Street adage, sell in May and walk away. However, some analysts think this year will buck the trend.
It's not as simple as looking at the calendar, and we think given how much bad news has been factored in January to April in 2008, it is likely that the summer will produce better performance in the U.S. market.
Bulls and bears agree there's little likelihood of a huge runaway rally in stocks. They say that won't happen until there's stronger evidence the economic and earnings outlooks are improving. Erica Miller, Nightly Business Report, New York.
President Bush is threatening to veto a bill that would send grants and loans to state governments to buy foreclosed homes. The measure is part of a broader housing bill expected to come to a vote on the House floor tomorrow. All this week, we're looking at the state of the nation's housing market. Tonight, we head to the Big Apple. Manhattan, unlike the city's other boroughs, has been insulated from the subprime mortgage crisis. But as Suzanne Pratt reports in tonight's Tale of 5 Cities, Manhattan hasn't been immune to falling home prices.
Manhattan resident Avery Kotler has been trying to sell his one-bedroom apartment for 2 months. That's so he and his wife can move to a new house they have already found in Brooklyn. Their Upper West Side space was first listed for $725,000, but after no offers, Kotler recently dropped the price to $699,000.
Sometimes you have an apartment on a great block and people love it, and maybe over the last few years you're conditioned to thinking it'll sell and you'll have a bidding war. That's definitely not happening, but all the smart people are telling me that things move with a little bit of patience.
For Kotler, those smart people include real estate broker Jill Sloan. She sold the apartment to him 4 years ago for $340,000, and she thinks it's priced spot on for the current market.
Understanding the state of Manhattan real estate has become a tall order. Until late last year, Manhattan was an anomaly, one of the few sweet spots in an otherwise souring U.S. housing market.
But in the last few months, there are finally signs of softening in Manhattan. The big question is by how much, and the answer depends on who you ask.
Things that are priced accurately are selling. I'm finding that for my exclusives, they are staying a little bit longer on the market, but I am getting close to the asking price.
Halstead is one of the city's premier real estate agencies, and President Diane Ramirez says by the firm's calculations, first quarter sales dropped about 1% from the same period last year.
When the credit crisis occurred, We thought we were not going to have a concern with it because we're not a subprime market. It's when it started to impact Wall Street where we realized we were not going to get out of this completely.
Appraiser Jonathan Miller is well known for taking the pulse of Manhattan real estate, and his latest assessment suggests the market may be losing its footing. According to his numbers, first quarter sales were down 34%. While that drop appears steep, Miller says it looks worse than it is because last year's sales activity was extremely strong.
The New York market, relative to other metro areas across the country, has continued to grow far longer than other markets, and the key reasons for that has been one of the key economic engines here has been the financial services sector, Wall Street, and Wall Street bonuses have been at or near record levels for the last 5 years.
Another reason New York real estate has held up well is the large number of foreign buyers looking to capitalize on the weak dollar. In addition, more families are opting to stay in the city rather than seeking big houses in the burbs. One metric that underscores the health of Manhattan's market is prices, which hit record highs in the first quarter. The median sales price of a Manhattan apartment was $945,000, up 13% from the year before. That's partly because high-end condo developments like the new Plaza and 15 Central Park West are selling for sky-high price tags. This 10-room Fifth Avenue listing, complete with Central Park views, is on the market for nearly $10 million and has had a steady stream of showings. The same is true for this newly renovated Greenwich Village 4-bedroom, which is currently offered at $6.5 million. Agents predict the luxury end of the market will continue to do well this year.
High-end has held up beautifully, and particularly because it doesn't really need the mortgage market. So that's not impacted by whether you can get a mortgage or not.
Surprisingly, there has only been a modest increase in total market inventory, but some brokers are concerned about the growing supply of 2-bedroom apartments. They believe that segment will be the weakest if New York real estate slides into recession. Still, most agree New York is in good shape to weather the nation's housing storm.
I think we're in a better position than many markets across the country because we don't have the inventory overhang going into this recession, if you agree that we're in a recession right now. However, we're looking at, I think I'm more concerned about 2009 than I'm about 2008.
Experts are concerned about next year because Wall Street bonuses are expected to drop and there could also be layoffs. Financial services account for about 5% of the jobs in New York City, but about a quarter of the wages. That makes Manhattan real estate strongly tied to the fortunes of Wall Street. Suzanne Pratt, Nightly Business Report, New York.
Tomorrow, our tale of five cities continues as we head to the suburbs of Detroit, where buyers and sellers are coping with a stagnant economy. Now let's take a look at our stocks in the news tonight. The most active big board issue on 21.5 million shares, Citigroup, rising 12 cents at the close, made a nice comeback from a low today of $25.05. Sprint Nextel moved up 47 cents. Cowen and Company brokerage upgraded it neutral to outperform. Then Fannie Mae, on that big loss, traded as low as $26.25, made a good comeback. Advanced Micro Devices up 59 cents. Companies alleging Intel paid computer companies not to buy its products. Pfizer, fifth in volume, was a 10-cent loser. General Electric down 18 cents. Ford Motor fell 6 cents. Quest Communications down 32 cents. First quarter earnings 9 cents, down from 12 cents last year. Revenues dropped about 1.5%. J.P. Morgan Chase moved up 20 cents in that strong financial sector. And then Countrywide Financial with a 2-cent loss. It was under fire from U.S. lawmakers and facing an investigation into whether it abused borrowers who had filed for bankruptcy. Countrywide admitted today it made errors and told a U.S. Senate panel it would make changes to avoid similar problems in the future. Then came Disney after the close with good earnings. Second quarter, 58 cents versus 44 last year, 7 cents above the street estimate. And after hours trading, it was up about 85 cents from this closing price. Legg Mason down $6.46. Fourth quarter loss of $1.81 versus earnings of last year. And the company's going to offer $1 billion in equity units, earnings dilution. New York Stock Exchange Euronext moved up $4.88. First quarter earnings 91 cents, 8 cents better than the street expected. Revenues soared 84%. Then McKesson up $4.16. Fourth quarter earnings $1.05, a nickel above the street estimate and up from 85 cents last year. The company is doubling its dividend quarterly from 6 cents to 12 cents. Nice move on McKesson today. IDARC up $1.52. The publisher of Yellow Pages had first quarter earnings of 76 cents. That was 13 cents above the street estimate. Comstock Resources gained $7.78. First quarter earnings jumped to 91 cents versus only 28 last year, and the street estimate was only 67 cents. It did very well. Interline Brands losing $2.66. First quarter earnings dropped to 27 cents from 29 last year, 3 cents below the street estimate. And then the big home builder, D.R. Horton, managed to gain 88 cents today despite a huge second quarter loss of $4.14. But the traded as low as $15.43 this morning, made a nice comeback. It's cutting its quarterly dividend in half, incidentally, from 15 cents to 7.5. Apple topped the NASDAQ actives, moving up $1.93. Yahoo up $1.35. The company says it's still available to potential suitors. Google down $8.54. Microsoft 62-cent gain, and Cisco closed up a nickel. And as you heard, third quarter earnings were 2 cents better than the street expected, but the stock didn't do much after hours. Research in Motion down $1.08. Baidu.com fell $3.43. First Solar up $9.75. Intel 33-cent gain. 10th in volume was Oracle with a nickel loss. Those are the stocks in the news tonight. Susie?
Paul, back now to our top story, those solid earnings from Cisco. Joining us now, Cisco Chairman and CEO John Chambers. Hi, John. Nice to see you.
Susie, it's a pleasure to be with you again.
Great. Well, you said today that you expect in the current quarter 9 to 10% revenue growth. What's going to drive that growth?
Well, I think it's very similar to what drove our growth last quarter. We had very good balance from a geographic point of view around the world. The strongest areas were actually Asia Pacific and Japan and Latin America. The areas where there was a little bit of a challenge were the U.S. But in terms of our product leadership, the pipeline looks very good. Networks have moved from being plumbing to how you do solutions if you're a business leader, or how you bring entertainment into your home if you're the service provider or the consumer. Nice way of saying, Susie, we're moving from just being a transport type of business to solutions for businesses, and going to be into entertainment into your home in the future.
Now, you just mentioned that a lot of your order growth is, in the past quarter was coming from overseas, less from the United States. Do you expect that trend to continue throughout 2008?
Not necessarily for the whole year. We said back in early February, I think on your show, Susie, that we expected the next couple of quarters in the U.S. to probably be bumpy, and that they would be a little bit challenging from an economic point of view. Unfortunately, that's turned out to be pretty accurate. Most of my customers are saying they see it turning up toward the end of the year, and most of my enterprise and service provider customers are saying, Cisco, we're getting closer to you, and you're going to get a larger share of our spend. So I feel pretty good about the factors we can control or influence.
Tell us a little bit more about how the slowing U.S. economy is impacting Cisco with all the belt-tightening that's going on. What impact is that having on your business?
Well, I think in the short term, orders tend to be a little bit harder to get in. They tend to slide out of one quarter to the next. But in the long term, most of our customers can only delay spending for so long. So actually, the companies who led us into this slowdown, the financial companies and manufacturing, which we showed up in the slowness of orders 2-3 quarters ago, actually accelerated this quarter and grew in the mid-teens. So it feels like a normal economic cycle. I think the Fed's doing the right thing, and I think most of my customers view that we'll come out of it toward the end of the year, and Cisco will get our share of spending in the process. But the key takeaway, Susie, is if you can grow at 10% when the economy's tough, think what you can do when the economies are good, and that's why we're so comfortable with our 12 to 17% growth going forward.
And when you say going forward, that is that 12 to 17% revenue growth. When do you see that kicking in? Is that going to happen in 2008, or is that going to be pushed into the new year?
I think you're going to look at that over the next 3 to 5 years to be what our average revenue growth will be.
All right. You also said on the analyst call today that you expect a growth burst over the next few years, and you compared it to the kind of growth that Cisco experienced back in the 1990s. Give us a little bit more color and characterization on what you mean by that growth burst.
Sure. I think there are probably three factors driving it, Susie. The first is the role of the network is changing. It's changing from just being a highway to literally the key enabler of all forms of communications and IT. That on that highway, you're going to have a lot more load first from video. And so networks loads won't grow at 50 or 100% a year like everybody would have said 2 to 3 years ago, but more like what we predicted at 2 to 300% would be the norm and 3 to 500% would be possible. That means you sell a lot more Cisco gear to make that happen.
Wow, okay.
Right behind that will be the next wave of productivity. It will be built around collaboration, what our kids invented on social networking, and the capability to use any device to get to any content. So this sharing in terms of productivity will drive the third wave of loads on the networks.
All right, sounds like an interesting time for your company. Thank you so much, John.
Susie, as always, it's a pleasure.
My guest tonight, John Chambers, Chairman and CEO of Cisco Systems.
Tomorrow, Street Critique guest Hillary Kramer talks scrap metal. She's market strategist at Green Tech Research.
Here's a look at what's happening tomorrow. The weekly report on crude oil and gasoline inventories is released, along with March consumer credit.
In tonight's Of Mutual Interest segment, we'll be looking at a large cap value fund that's managed to do better than most in that category. It's called the Mont Eagle Value Fund. Only barely in the red to date, it has beaten the Standard & Poor's by wide margins over the past 5 years, and since its inception 9 years ago, it's had an 11% annualized return. Rusty Robinson has been Mont Eagle Value Fund's manager for that entire time, and Rusty, welcome to Nightly Business Report.
Thank you for having me.
Let me first ask you, how have you managed to ride out the market's downturn with minimal damage?
Well, we have continued to be committed to the positions we took 2 to 3 years ago, primarily in the energy and the industrial and materials industries.
Now, you say that your strategy is to invest in undervalued companies. Does that mean you're getting ready to go after some of those really beaten down stocks like financials?
Well, we're interested in the financials. We would like to see more of the companies complete the process of dealing with their subprime lending problems.
Do you have some specific names that you're looking at?
We would prefer to gravitate toward the larger companies. Obviously, Citicorp and Bank America are the larger companies. We're more concerned about with the regionals that they still may have a few more problems to deal with in the real estate industry.
Well, your fund has no doubt benefited from its large holdings of oil and oil service stocks. Do you still consider this sector to be undervalued?
Well, most of our positions continue to buy back their shares. They also trade within 9 to 10 times earnings for this year's earnings, and they also trade around 5 to 6 times cash flow.
Okay, we just have a minute. Just give us your favorite oil stocks, 1 or 2 of them.
Well, we still believe with Exxon buying back shares that the oil service industries are will do more, will benefit more from what is going on with $122 oil.
Okay. Are there stocks in other sectors that you like now?
Well, we have been playing with technology for the last year and a half. We have some positions in Microsoft and Intel.
Okay.
And believe that the larger companies will benefit more than the smaller companies.
Okay, interesting. Do you personally own any of the stocks that you've just mentioned?
We do not. I do not.
Okay. Rusty, I want to thank you for being with us tonight and continued good luck.
Thank you so much for having me, Paul.
My guest, Rusty Robinson of the Mont Eagle Value Fund.
And that's Nightly Business Report for Tuesday, May 6th. I'm Susie Garrett. Good night, everyone. And good night to you, Paul.
Good night, Susie. I'm Paul Kangas, wishing all of you the best of goodbye.
Nightly Business Report is made possible by
Franklin Templeton Investments. After 50 years of worldwide investing, we see market opportunities through the eyes of experience. Franklin Templeton Investments. Gain from our perspective.
This program was made possible by contributions to your PBS station from viewers like you. Thank you.
Thanks, members. Your support of smart and engaging public broadcasting makes all the difference. We couldn't do it without you. Thank you.